Your radio is set to the retirement income source where it's always about investing for income the old-fashioned way. Not just investing for income. When people come into our from the radio show, we get a lot of people that come in wanting to know more, investigate more about income, and when they find out, they're really what I see more than anything is a dramatic income increase that they're not getting currently right now. And so, imagine increasing your income or supersizing your income 3 to 4 times more than what you're already getting right now. Because you can ask anybody whenever I'm in an audience, or when I ask somebody in the audience, like a retirement seminar or an educational workshop, I'll ask them, I'm willing to bet most of the people in this room can come close to telling me how much return they made on their money in 2023, and by hindsight. Because, if we watch our money, what we basically do is we look at the bottom line. We look at when I say that, what I'm talking about is we look at what our return was made for the year. And so that's kind of how we gauge our performance. If we hired a financial advisor, we want to make sure that they're always helping us to win, right? It's all about winning. Well, if your return was 20% or 18%, that's pretty good, right? If anybody made that kind of return last year, that's great. But you also took a lot of risks to get that return, right? Because when you go into retirement, it's always not just about the risk you're taking, but also about how much return you're making every year, not just a year or two. Because sometimes we find that people look at the good years and not really realize that the bad years also has something to do with the calculation of their total return. Because at the end of the day, if you look at 2022, you may have had a negative 15 or an 18% or maybe a 25% return on your portfolio. But you don't really want to talk about that. All you care about is the years that you made a good return. It's almost like we ignore the reality of how average returns work. But when you go into retirement, you don't want to ignore the reality of how returns work, because at the end of the day, if you made 18 or 20% last year, or even had a negative number the year before, you got to ask yourself, especially if you need income in retirement, what is the reliable component of that portfolio as far as making a total return? So if you made 20%, how much of that came from dividends for the full 12 months? You see, even though we're trying to solve income for retirement, we ignore the most important component. Because after all, do you need reliable income? Because in 2022, the markets went down. So if your reliable income was 2%, that means you can spend 2% and not touch your principal. And let's just say you spent 2%. And in 2023, when the market went up 20%, you still only made 2% from the dividend. So 18% came from capital appreciation in 2023. You lost, let's just say 15 or 18% from capital depreciation the year before. But regardless, the positive number is always the 2%, the dividend in of itself. And if you think about it, what is important in retirement? To have reliable income or have hope and wish income? In other words, you wish it goes up. You cross your fingers, you cross your toes, and hope you get a return. Last year, thank goodness, it actually happened, but the year before it did not happen. At the end of the day, we want reliable income. And that's what I mean when I say income the old-fashioned way. You see, the reason I know that is I've been doing this for 20 years. I'm not the smartest man in the tool shed, but one thing I've learned about income is there is a distinct difference between income and growth. Because in 20 years, the first 15 years was a learning experience. The learning experience was I'm not really helping people to get more mileage out of their money. I'm helping people to hope they get more mileage out of their money. And so if I focused on growth, which is what exactly the retirement advice that we were actually giving our clients, then I'm hoping it's going to work out. Some years it actually did. I mean, we were high-fiving and I was their little cheerleader. If you remember, right before a ball game, you'd have a pep rally and I would be their cheerleader and I would encourage them that everything's going to be great in the good years. And then when the down years, I would even have a bigger pep rally. But at the end of the day, it still didn't make people feel comfortable because they really didn't understand the return on their money, because they need a return on their money. And guess what? They're in retirement and they're not getting a return if the portfolio is dropping in value. So you got to have something that's actually reliable. That's the reason I brought up the 2%. If you're listening to this show right now and you only need 2% in retirement, then you're probably getting that in dividends in your portfolio right now. Now, if your focus is more on growth, you're not. But if you got maybe a hybrid plan where you got 50% stocks, 50% bonds, primarily in mutual funds, and you probably are maybe getting 2% in your portfolio, which means you're not touching your principal. And if you just continue to maintain that withdrawal rate of 2% of just nothing but the dividend, yeah, you're going to go ups and downs and so ebb and flow with the market, but good news is you still got your principal intact. And then when the markets do recover, which you have no control of when they're going to recover, at least your portfolio will start climbing again, because you have still the whole farm still intact, and all you're doing is just living off those minuscule dividends of 2%. So if this makes sense to you, in other words, you would like to learn a little bit more what I mean about a successful retirement formula called the total return equals I plus G, interest and dividends plus growth. In other words, they're both distinctly different in a lot of ways. You don't want to go through retirement and find out that you've been using a growth strategy all along, and to your disappointment, you wind up having a reduced portfolio to the point you cannot recover, and therefore you have to start reducing your spending. You don't want to do that. The successful formula always has something to do with the I first, interest and dividends. Well, this commission report can be yours if you call 888-930-1080. Again, that's 888-930-1080. And we will mail this to you or email it, whichever you prefer. It's a real quick, short read, but very, very powerful in understanding total return equals I plus G. Having the successful retirement formula that get you through retirement, not the same tools that you got to retirement. And again, that number is 888-930-1080. You're tuned in to the Retirement Income Source. I'm Tim Sparks, and we're talking about refinancing for more income. You see, you may be thinking, am I off my knocker here? What do you mean by refinancing? When it comes to planning for retirement, and especially when it comes to income from your investments, you want the most income because that's what retirement is all about. You got to replace those paychecks during your working years that you had. And Social Security, we all know, is not enough. And most people don't even know how much income they do need in retirement. And if a lot of people, when they come into our radio show, they actually and they have an appointment, what they learn real quick is how much, first of all, they're already spending right now, so that way they can get close to what it was whenever they were working. That's the reason why people don't want to give up working, and because they're fearful that they're not going to be able to earn enough in their own portfolio. Do you know the number one biggest fear of 61% of retirees is having a lack of income in retirement? Then why not take advantage of higher income first investment tools while they're still available? And that survey came from AARP. You see, it amazes me that when mortgage rates actually drop, we'll immediately try to lower interest so that way we can pay less interest on our mortgage debt, or maybe even our car loans. Or even credit cards. We may want to look for a credit card where we can get zero interest maybe for 12 months and try to pay toward that principal and get that debt out behind us as soon as possible. All those things are financially important, but shouldn't it be equally important to increase your income? That's what I mean by refinancing for more income, because right now interest rates are up, and interest rates are expected to come down eventually. Well, if you think about it for a moment, they said rates may drop, and they said it earlier the year, but nobody really, we started believing it, assuming it, and it didn't really happen, right? Because inflation numbers started coming back up. Well, the recent inflation numbers actually dropped. So that means the last 12-month average for inflation is starting to decrease. Now, next month it may change, but right now I'm expecting Powell to drop interest rates 1/4 to 0.5%. Again, I'm just speculating, and that is my opinion. But if he does, that's good news for in people that are in the stock market, that now they may have growth, the tailwind at their back. But our clients are investing for income, and it doesn't really matter if they raise interest rates or lower interest rates. If they lower interest rates, if they're in high income instruments right now that are paying income, especially people that's came in the last 12 to 18 months, they're getting high income from their portfolio they otherwise would not have. Think about it for a moment. If you had $1 million invested, how would you like to get another $1,000 to $1,500 more a month than you were just a year or 2 years before? That is pretty significant when it comes to income. And right now, income is a problem that we all are trying to solve. Not only do we need more income, we are challenged with inflation. When you're challenged with inflation, you need more income, because it's about cash flow exceeding the expenses that you're purchasing. And not only that, you might be able, if you don't even need the extra income, you may take that extra income and be able to either reinvest it, that's what some people would do, or they might be able to give some maybe to their kids they've not been able to do in the past couple years when the markets were very volatile. Or you might be able to actually do some things you've been wanting to do, you've been putting off. You see, investing for higher income is a good problem to have in retirement. So if you want to learn more about income first methods that make more sense when it comes to retirement, keep in mind, we're trying to make common sense out of income. That's what this show is all about. Now I want to let you know about an excellent video retirement kit with 3 short vignettes. Less than 20 minutes, you can actually go through these videos, and little cartoon-like characters are actually making some sense out of money. In other words, you're going to learn some strategies of what our clients are utilizing each and every day to have income first methods. And I got a free copy for the first 5 callers of today's retirement income source. You can call 888-930-1080 and get that video retirement kit. Again, that's 888-930-1080. And we will mail it to you if you're one of the first first 5 callers, free video retirement kit, 888-930-1080. You're tuned in to the Retirement Income Source with Tim Sparks. We'll have more on income first methods, and we will be right back. We're back, and you're listening to the Retirement Income Source with Tim Sparks, your host, sponsored by Sparks Financial Group, right here in the heart of the Bluegrass, Lexington, Kentucky. Today we're talking about refinancing for more income. Income the old-fashioned way. Not the way that you're probably doing it right now if you're in retirement right now. You see, you can withdraw money from your portfolio and call it income, and that's not what I'm talking about. And you probably need to actually explore and find out what it is I'm talking about. Because at the end of the day, we all want more mileage on our money. And if your portfolio is focusing on growth first and income second, then you're going to get less mileage than somebody that has income first and growth second. Doesn't mean you have to actually invest for non-growth instruments to be able to get income. You see, you can invest in growth in stocks in the growth way, or you can invest in stocks in an income way. They both, when the markets are going up and doing well, they both go up in value. The share prices do that you own. But if you're growth first, it means you're spending growth. You means you're spending shares to come up with the same income. Our clients are not spending shares. They're just spending the dividends that are paid to them anyway. Now think about it for a moment. Dividends are consistent and they're much more reliable than it is whenever it comes to spending growth. You cannot always get growth in your portfolio. I mean, we're in a time right now, I don't know about you all, but I've been noticing the markets are very sporadic. 1 or 2 years they go up. Thank goodness, maybe we're wiping off our eyebrow. Thank goodness the markets are finally starting to recover. And then before you know it, the markets start decreasing. All of a sudden you start getting bad news again, and all of a sudden the markets go down. Think about it. 2020, for example. We can go back in time and talk about the patterns of stock market history, and we all know that markets have a tendency to repeat themselves more often than not. But just in the last 4 years, 2020, the market started off, the pandemic drove the market performance, the S&P 500 down 35 to 40%. And it went down very quickly, if y'all remember, in a little over a month. Yes, it did recover, but it took almost by mid to the end of the year for the market recovered, and that's only because of the helicopter dollars that started coming out of the Federal Reserve to print more money. When they print money, they're basically helping the markets go up. So, at the end of the day, sometimes we rely too much that we think that the federal government's going to continue to bail out the markets every time they go down. Well, so far so good, but it don't always work out that way. In 2022, they had their hands tied. They couldn't actually infuse money and throw out helicopter dollars. Why? Because now they got to slow it down. And some believe that what caused inflation was the printing of money, and I'll be honest with you, I totally agree. So, when inflation starts coming up, they have to slow down. They cannot spend money and infuse money into the economy. So in other words, you have to sit there and take it on the chin. You see, that's not a retirement plan wondering what is going to happen on a day-by-day basis, because we all know bad news means what? Bad news to the market means you're going to have some volatility. And other times, good news means the markets actually are resilient and they go up. And so that, to me, that's too much wishy-washy of a retirement plan. I don't want something where I'm totally relying on market growth to get me in retirement, because I'm going to be very disappointed. And not only that, I'm not going to get the mileage out of my money that I need, because I focused on the wrong instruments to get me through retirement. Those instruments are not income-based instruments. They're non-income based. And so that means when the markets are going down, you're going to spend less because you're going to tighten your checkbook because the markets are not cooperating. And then other years when they finally do cooperate, you spend, but maybe you spend cautiously. Why? Because you're in retirement now. You don't want that portfolio to drop. And you see how drastically the portfolio can drop, and also how quick the portfolio can go up. And so at the end of the day, markets go up and they go down, and very sporadic. And just like I started about a minute ago, being sporadic, going drastically up some years and then drastically down some years is not, to me, it makes me feel really good by having a retirement plan totally reliable on growth, because growth will not work. I cannot will the markets to go up even though I go into retirement. And I definitely don't want to trust a crystal ball, because that's exactly what we're doing when we're putting money in the market and hoping the markets perform while we're in retirement, just for our retirement income needs. Well, I want to get a commission report in your hand called The Hard Lessons of Stock Market History. We're talking about stock markets come and go. And when you read this report, you're going to find out that historically The markets have always had recessions, corrections, and it's always had recoveries and bull markets. So with that being said, you need to understand that the patterns of the market should drive you to make a decision on how you want your philosophy of income in retirement, because you don't know which way the markets are going to go while you're in retirement. So there is another component, total return equals I plus G, the dividend side, that can actually get you through. It doesn't matter if the markets are up, down, or sideways. And this report will be able to help you, first and foremost, the education you need to be able to understand how volatility works, and then whether you want to ride that train or not. And you can have this report by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail it or email it, whichever you prefer. Again, that number is 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks, and we're talking about refinancing for more income. You see, when it comes to planning for retirement, especially when it comes to income from investments, you want the most income, because that's what retirement is all about, replacing those paychecks during your working years. Since the number one fear in retirement is running out of money, well, according to AARP, is having a lack of income in retirement. So you want to be able to take advantage of high income first investment tools first, while they're still available. That's how you get the most mileage out of your money. Don't spend principal first, spend income first. And if you need anything in addition to income, then spend your principal. But first of all, if you've already got, let's just say I'm using $1 million. Let's just say you've got $50,000 that you can count on. That's $4,000 a month in the next 12 months. And if you need any more than that, then spend your principal. I don't recommend it, but spend your principal. It's a lot better than the alternative option, because on the portfolios we're examining today with the retirement risk report that we use, people are only getting $10,000 to $15,000 a year. So I don't know about you, if I had $1,000 to $1,200 a month coming in and I've got to spend now $3,000 a month in principal, I'd rather refinance my daggone portfolio so that way I can get more income. Therefore, I've got $3,000 a month coming in interest and dividends, and therefore I'm spending less principal. It's the whole point of this right here is to get more mileage out of your money. And there couldn't be a better time. I can tell you right now, when they start lowering rates, the income first method is going to start decreasing. Doesn't mean our clients are still not getting income. It just means they could get income of a lesser amount if they continue to delay this decision. I mean, think about it for a moment. I was putting some numbers together, and today when people come in and they have a well-balanced, customized income first portfolio where they have a mixture of stocks and bonds, that means they got stocks and income. And by the way, you got stocks and bonds in your portfolio too. The difference is ours are more income focused, yours are more growth focused, including the bonds. Bonds that you have are bond funds. They pay less income than individual bonds. But at the end of the day, you're getting $50,000 to $60,000 a year before you touch your principal. If you wait a year from now, it's going to be $40,000 to $45,000 a year before you touch your principal. I don't know about you, but if I can get another $1,000, $1,500 more dollars a month in income right now, I'm going to start refinancing right now before I miss the train, before it starts leaving the tracks. And not only that, if you're planning on retiring soon, if you're 59 and a half and older right now, and you're going to be retiring within the next 10 years or sooner, then you want to be able to transition as soon as possible. Why? Because you want to hit your target date. Because think about it for a moment. You don't know where the markets are going to be in 10 years. Your whole retirement plan can be derailed because you didn't transition soon enough. Because accumulation-like instruments are just that. They have to continue to accumulate. Yeah, you're setting aside dollars in your 401k and accumulating shares, but how would you like to supersize that and be able to put it on steroids while you're still working? If you have $500,000 in 401k right now, the dividend it's getting inside your 401k is about $12,000 to $15,000 a year. What if you can get 20 to 25,000 a year on the same 500,000 by just doing an in-service rollover? It makes more sense. That means you're going to be able to buy even more shares because you made that transition now. So if you want to know more about income first methods that make sense for retirement, transition into retirement, increasing your dollars, increasing your dollar cost average, and even if you're not in retirement and you're over 59 and a half. I got a video retirement kit with 3 short vignettes, less than 20 minutes in length, that will help you to be able to understand what we mean by income first and why it's so important to transition as soon as possible. And I can tell you right now, people that intentionally do that actually intentionally get the retirement plan they envision. And I got a free copy of this video retirement kit if you're one of the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this out to your email at whichever you prefer, 888-930-1080. You're tuned in to the Retirement Income Source with Tim Sparks. I'll be right back. Welcome to the Retirement Income Source with Tim Sparks, your host, and our show is sponsored by Sparks Financial Group, a financial firm right here in the heart of Bluegrass, Lexington, Kentucky. Today, we're talking about refinancing for more income, and I mean income the old-fashioned way. Give yourself a pay raise while it lasts. You should actually try it. You may be surprised at how much more mileage you will get out of your money. You know, retirement income is a long-term liability. You don't know how long you're going to live, so do you want long-term income instruments or do you want short-term instruments, which is what some people right now are actually relying on with money market accounts and stuff that are paying some interest for a change. But even though the interest is paying, 4 or 5% right now, keep in mind that train is going to decrease every time Powell lowers the interest rate. In other words, you're going to be right back to spending principal in a safe way. In other words, you could be going broke in a safe way. What you may not know may hurt you. You see, at the end of the day, if I can get 8 or 10 years of $1,000 to $1,500 more in income per month by just simply refinancing while the rates last, then why not take advantage of that? Because anytime I can get extra, that means I'm going to get more mileage out of my money. Of course, unfortunately, people, even if we increase their income in a low interest rate environment to 4 to 4.5% on average, and I'm talking about net returns here, people. This is because, obviously, financial advisors have, they charge fees, right? I'm a fiduciary, so we basically just charge a fee to manage your assets. So when I talk about a return, especially when it comes to anything we're talking about or what you're already doing, I'm always going to be talking about the net income so that way you can differentiate the difference. Because right now your net income on a 60-40 portfolio, that's 60% in stocks and 40% in bond funds, because you're using mutual funds to get through retirement, you're getting on $1 million about $15,000 a year. If you refinance that portfolio into more of an income first, you're going to increase it from $15,000 a year to $50,000 to $60,000 a year. Yep, you heard that correct, people. That's no joke. Actually, people that actually come in or they call in on the radio show once they discover it, it's the Missouri state was known for the show me state, right? Show me, prove it to me, and then okay, what do we do next? And so at the end of the day, it's always about the extra paycheck, the extra income. I mean, I don't know if there's anybody out there whenever they were working that didn't like bonuses whenever they occurred. Well, that's, believe it or not, when you actually increase your income and refinance your portfolio where you're actually increasing it, you're actually giving yourself a bonus, believe it or not, but it's actually intentionally now. Because, what worked well in accumulating assets, you really didn't have to have income first. As a matter of fact, that would have hurt you when you're actually creating wealth. But it will also hurt you if you use that strategy when you actually go through retirement, because now just the opposite, you're actually no longer buying shares, you're actually selling shares. In whether it's an up market, you're selling less shares. In a down market, you're selling more shares. You're just selling shares always for the next 20 to 30 years. So the question you have to ask yourself, I hope I don't run out of shares before I run out of breath. Did you know there are 3 benefits of an income first, growth second like type of approach? It's what we utilize. Because it doesn't really matter at the end of the day. We know everybody wants both growth and income. But if you focus on income first, you now actually have an opportunity to be able to grow your assets, because you're not selling shares, and it's the shares that actually go up in value or go down in value, not the income that the share per share pays. So that's the first thing that you got to realize, that when you use the income first method, it's always going to give you more income. That's the reason why it's so important to refinance, so that way you can increase those paychecks and spend less of your principal. Also, the number 2 best benefit, it's always you're always going to be reducing your risk. Now, why are you reducing your risk? Well, it's a defensive method, and we all know whenever an NFL coach is trying their best to get to the Super Bowl, they know that if they're going to win the game, it's always going to be based on defense and not going to be based on offense. Yes, you need offense, but you got to have defense to stop the other team. And so, if you think about it for a moment, you tell me, is dividend value stocks riskier or growth stocks riskier? Well, I hope you answered the latter. Growth stocks are always going to be more riskier because there's less defense. Dividend value stocks pays more defense and a little bit more conservative than the growth stocks. Now, at the end of the day, when it comes to growth or value, and it's stock, a stock is a stock. It's a duck, it quacks. So if the markets go down, yes, you're going to see some value decrease. But at the end of the day, if it's managed correctly by an income specialist, an analyst that focuses on dividends that pay, or stocks that pay dividends, then they're trying to minimize that risk as much as possible of the company cutting a dividend. And not only that, with still potential opportunity to be able to get growth out of your portfolio. So another way of looking at less risk, are bonds lesser risk than dividend stocks? Absolutely, bonds are. Why? Because they're contractual instruments. Insurance companies know this very well. That's how they assess the risk when it comes to umbrella insurance, car insurance, homeowners insurance. If you purchase annuity, it's longevity insurance. Life insurance protects against the event of a death early on of the main wage earner of a home. I mean, at the end of the day, think about it for a moment. They're assessing risk using bonds, but they use individual bonds because individual bonds pay more income than bond funds. So at the end of the day, if you got your defensive approach is more income, then you have the best defensive approach you can when you're going through retirement and not running the risk of running out of money before you run out of breath. And most importantly, you get more potential return by having income first and growth second. So if this makes sense to you, then I want to get a report in your hand that helps you to understand the income first instruments. It's the universe of income generating financial strategies. And you're going to see a seesaw kind of component here that shows you the conservative side all the way to the aggressive side of how you can get income first type of investments. And this commission report can be yours if you call 888-930-1080. Again, that's 888-930-1080. And we'll mail this to you or email it to you, whichever you prefer. Again, that number is 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks, and today we're talking about refinancing for more income. The train is about ready to leave the depot. I talked about this several weeks ago, talking about opportunities are never missed. and you want to take advantage of those opportunities while they still last. I mean, even if you don't need too much income that's coming in the portfolio at the level that our clients are collecting, doesn't mean that that's a bad thing. That just means too much income means you have the ability to save more. Imagine being able to save in retirement because you got too much income. It's the same way it is when you were working. If you had too much income, you saved more. We all like the ability to be able to do both. That's what income does. It gives you the ability to be able to save more. And I'll go on to say that we have a client right now that started the income first method, and they're still working. They're going to be about 4 or 5 years away, but they decided that they're going to purchase a particular hybrid long-term care life insurance plan that allows them to be able to have both life insurance tax-free and long-term care tax-free, just in case they need it for the purpose of living benefit for long-term care benefits. And they do that by the dividends that's coming in a portfolio that's not going to change 5 years from now whenever they go into retirement. But when they go into retirement, they can spend it for themselves. Right now, they're going to be able to accumulate enough in this long-term care policy to be able to protect her, because she is more concerned about she may get or contract dementia while she's in retirement or later on when she gets older, because she's actually seen her parents go through this. And so you want to be able to have a way to be able to purchase that. You can do that by having income first methods, especially even if you're not in retirement yet. You can actually start doing that now. Why? Because your portfolio, you're missing out totally, can generate income already and not negate the income whenever you get ready to go into retirement down the road. That's what intentional investing for income is all about. You get the income, therefore it allows you to have the flexibility to be able to do things with income that is going to be a bonus to you. In this case, she's taking advantage of this bonus for the purpose of having long-term care insurance. So in other words, if she didn't have the income first component, which most people don't have this income first component that are listening to this show, they're not going to be able to have those tools and be able to utilize those tools, because we all know we don't want long-term care insurance because we don't like to pay for it, and not only that, it's getting really expensive. Well, we would like to have it, but we don't want to pay for it. Well, why not let the interest and dividends pay for that care? And that's exactly what this couple did. They decided that it made perfect sense, because she don't know how long she's going to live. There's longevity in her family. Plus, there's also dementia in her family. So just in case she wanted to be able to leave assets behind, you can't leave assets behind if you're spending your principal going through retirement, because that was the first problem she found out early on. It's the reason why she switched to the income first method. And while she's getting the income, why not take care of another problem, which is let's protect our portfolio against long-term care insurance, which, by the way, we all know is very expensive today. I covered a little bit of this last week on our estate planning workshop, estate planning radio show that I actually teach in the workshops, talking about actually how people will actually spend down their assets because they're trying to self-insure, and if they had long-term care insurance, it minimizes the risk of being able to spend down their assets, especially if they're legacy-minded. And by the way, let me share with you the success of this particular portfolio right here since they started working with us with income first, growth second, and how you get more potential return while you're generating income, even though you're not in retirement yet. Well, you see, extra income allows you to save more in retirement. So there's one thing that you're going to get to do by using this method. It allows you to reinvest more money. Because on $1 million mutual fund portfolio in a 401k, you're getting about $15,000 a year. And if you transition that money, that $1 million out of your 401k, and you're over 59 and a half, you can generate 40, 50, or even 60,000 a year with the same $1 million. You tell me which one of those are going, from a reinvestment standpoint, and might as well call it a saving method, is going to actually accumulate more shares. You said it, the latter, always the latter. Well, with that being said, that's exactly what happened with this couple. They've been with us 3 years, and their portfolio keeps growing. And not only that, when the markets went down in 2022, they were capitalists. They were buying. They had more money to be able to buy when the markets were down. Most people don't have that ability when they're growth first, second, and income second. You don't have that ability because you have less income buying shares. And so again, it's all about the income. The income gives you more flexibility to be able to invest more and be able to buy more shares. At the end of the day, it's all about buying shares. The more shares you buy, the more income you're going to increase into the future. If you want to learn more about that, then I want to get an income first method video retirement kit with 3 short vignettes, about 20 minutes in length, a little less than that will get the point across when it comes toward interest and dividends first. And good news is, remember, it's more income, less risk, and more potential return. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080, and we will mail it to you. Or if you call in and you're one of the first 5 callers of today's retirement income source, you can again get that report mailed to you, 888-930-1080. You're tuned in to the retirement income source with Tim Sparks. We'll have more on income first methods and refinancing now and taking advantage of while the supplies last. We'll be right back. Welcome to the Retirement Income Source of Tim Sparks. Our show is sponsored by Sparks Financial Group, a financial firm right here in the heart of the Bluegrass, Lexington, Kentucky. And today we're talking about refinancing for more income the old-fashioned way. You should try it. It may surprise you by getting more mileage out of your money. At the end of the day, most people are concerned about having income. Well, if you're in the market and using market-based investments, you're probably not getting the income that our clients are getting, and they're been able to collect extra paychecks they otherwise would not have if they had not invested for the right time of life. And that is, whenever you want to be successful in retirement, then you need to transition to investments that actually pay more income first and growth second. Again, that lessens your risk, gives you more potential return, because now you're maintaining those shares, just like a $1 million eightplex, for example. Use an example. If you're collecting income from that eightplex, then that eightplex over time is going to continue to go up in value. And you're not as concerned if it goes down in value. Why? Because it's those checks that you're collecting from those renters that's more important. It's all about income first. So I'm going to just share with you here in about 5 weeks, I think it's October 22nd, my book, The Retirement Income Shift, How to Get the Most Mileage Out of Your Money, is actually going to be released. Right now, it's on pre-order at Barnes & Noble and also with Amazon. And we're expecting it to be #1 on Amazon within the next few months. That's at least my intention. I have a website to where people can actually go to. It should be coming up here soon. But a lot of the things I talk about in the book and the stories and stuff tries to get the point across. And also we have a YouTube that I actually record all of my radio shows on. In other words, it's me on a video doing my radio show, but also I do some visuals on there that are really, really powerful that I think it really helps people. If you're a visual like myself, visuals are extremely important to be able to drive home what we're trying to actually help people to understand when it comes to income. And also you got the radio archives. You can always go to our website, www.sparks, SPARKS, FG stands for Financial Group.com, and you can actually see our radio show. There are the archives week by week, so that and because there's times that people may only hear our show maybe for 3 or 4 minutes because they're about ready to go eat lunch or whatever. The good news is you can always go and listen to that and be able to get more and more information when it comes to investing for income. So we think it's extremely important to be able to make sure that you get all the information, because it's all about knowledge, right? And speaking of knowledge, if you want to know more about an income first method, then I want to get a commission report in your hand. Total return equals I plus G. It's a successful formula for the people that want to retire and live comfortably in retirement. And this commission report can be yours if you call 888-930-1080. Again, that's 888-930-1080. And we'll mail it to your email at whichever you prefer. Again, that's 888-930-1080. You're tuned in to the Retirement Income Source. It's Tim Sparks, and we're talking about refinancing for more income. See, when it comes to plan for retirement, especially when it comes to income from your investments, we all want the most income, because that's what retirement is all about, replacing those paychecks during your working years. Social Security in of itself is not enough. You see, the biggest fear for 61% of the retirees, according to AARP, is having a lack of income in retirement. This is why people are delaying retirement and working longer. But if you take advantage of high income first investment tools that are still available, then you may already be ready to retire right now. I mean, we had a couple in just the other day, and they have a certain amount of money. They've already been investing with us now for a few years, and even though they were going to retire in 4 years, they've decided maybe to work part-time and leave the company to work. They still want to work, but they want to work somewhere else and not work where they're at. I don't know why. They probably just don't like their environment they're in. But they're wanting to know what is the income now, so that way they can have at least a plan B in place while they're looking around and maybe looking for part-time employment. And what they didn't realize is, since income was up more than what it was then, we made some changes with some of their portfolio in a rebalancing way that we got to increase their income to the point where they're actually got more income coming in now than what they were actually making while they're working. And not only that, it allows them to be able to delay Social Security if they choose so. It's always nice when you have an income coming in that you can have that flexibility to be able to make those changes. So you got to keep in mind, a portfolio with income first, growth second, portfolio by design, you're going to be minimizing the gambling when it comes to retirement, because most people are hoping for growth. That's gambling. Do you think a farmer worries about getting their land value up when the crops are easily providing their income every year anyway? Absolutely not. Well, I mean, that would be insane, right? Because that's what the purpose of the farm is. Well, land goes up in value over time. We all know that. Well, so do stocks if you invest in the income way. But unfortunately, most people doesn't realize that growth and income are distinctly different in a lot of ways, especially when it comes to income first methods that people are actually don't really realize that are actually available, and especially right now. Like I had said earlier, the income right now compared to what if rates come down, income's going to probably drop $1,000 to $1,500 a month just in another 12 months to a year, or 12 months to the next 18 months. And if they do, then you're going to wind up missing out on that extra income. Keep in mind, inflation is a problem, and the goal is to get the most income. And if you got more income than you need, don't worry, that's a good problem to have when you're in retirement. And keep in mind that stock and bond mutual funds and money markets is not a retirement plan. It's a retirement cash flow plan where you're spending principal, and it doesn't matter what level, because at the end of the day, it's with the income is so small that it's like looking for a needle in a haystack, because you're relying on your principal to continue to increase with growth. And what people don't realize is most mutual funds underperform their respective indices anyway, about 95%. Just Google it, find out for yourself. And so even you got index funds that people use that are real close, but they're not actually the index in of itself. You can't invest actually in the index. You have to find good funds like Vanguard or iShares that are actually trying to mirror the index, but unfortunately they even tell the index slightly. So, and not only that, mutual funds have a growth first, income based type portfolio. The growth is what's the highest priority, and so therefore you're having to rely on growth that gets you through retirement, and growth can be very disappointing, especially when you look back historically. There has been patterns when the markets didn't have no growth whatsoever. Another thing with mutual funds you got to be aware of is there's hidden fees inside of them. You don't have to take my word for it. I mean, good night. They've had several articles that came out in Wall Street Journal and New York Times that actually was written by actual analysts actually divulging the dirty laundry of mutual funds. Am I being critical of them? I am kind of when it comes to retirement, because people need income in retirement, and a lot of times these are the same tools that people are trying to get through retirement, and those are anti-income. So it's just, it's a matter of preference. I mean, don't get me wrong, you probably use them, and so far so good, but once that market turns south and it may be, you go through a 40 or 50% trough, you may find out that you're never ever going to be able to recover your money that you spent in retirement. So with that being said, we've come up to the end of our show, and I want to let you know about an excellent video retirement kit that has 3 short vignettes talking about income first methods. Now, I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we will mail this out to you, free, no obligation video retirement kit. We hope you've enjoyed the show today, and keep in mind, take advantage of the opportunities while they still last. Income is for sale right now, and it's up, and when rates come down, you're going to be missing out. Could be a pretty significant amount of income that you wish you could have had, and since you didn't invest that way, you're hoping for growth otherwise. You've been tuned into the Retirement Income Source, and we've come up to the end of the show. We hope you enjoyed it. We look forward to another great show next week. Thanks for listening.